This is Mike with my real estate dojo, and I want to explain to you today's lesson about why I don't like subject to deals. Now, before I say that, I love subject to deals. I think they're the best way to do a transaction by using somebody else's underlying mortgage, but there are some cons to it. So let me go through some of the list of the cons so you guys know. Number one, that everybody knows, that there is something called due on sell clause, and basically a due on sell clause means that the original lender can call up the note if you buy the house, taking over the original borrower's loan. So again, let me put it another way. If I take over this seller's payment, that seller had a bank that lent it to him. This bank can foreclose on me because this seller has sold the property to me, and this seller did not cash out this underlying lender. So that's one risk. But to tell you the truth, I don't really fear that at all. It's a very, 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 very small risk. So I'm not worried about that at all. But I want to just bring that up because that's what everybody always asks me. Now, the risk that I've noticed in my business is that, number two, is that I may take over some motivated sellers' house payments. They're behind, or they might be going through a divorce. And 5-6 years down the line, their circumstance will change. At that time in their life, they were motivated. At this new chapter, they're not motivated, and they may want to buy a new home. So I had sellers that call me up and say, "Hey, Mike, when are you going to cash out this loan? You said you're going to cash it out." And that's when I remind them and show them the paperwork that, "Hey, buddy, I never promised you that I was going to cash out the loan at any certain period of time. I told you I was going to retire the loan," which means like whenever your loan ends, that's when my obligation ends to you. So the number two risk is that you might find a motivated seller 5, 10, 20 years down the line. Their circumstances may be different, and they may want to get a new home, and they may not be able to qualify for a new home, may not, if they have bad credit or if their debt to income ratio is jacked up. Now, there's things to do in this situation to help the seller out, but I don't want to get into this video right now. So the number two reason why I don't like subject twos is because sellers down the line, their situation is going to be different, and they may not want this loan in their name anymore because they want to buy a house. Let me give you number three. It's basically the same exact idea, but another reason is that, a seller may sell you the home. They decide to live in an apartment for a couple of years. Now they realize they can't get buy another house, or their situation has changed. Now they want the home back. So that could be a risk factor. Okay, I haven't had problems like that, but only one guy that brought that up. So that could be another risk factor. But besides that, there's really not that much risk in my mind because I'm taking out somebody else's loan. I didn't have to pay all that junk fees. I didn't have to qualify. I didn't have to put it under my credit, my social security, and I just take over the guy's payments. And so the risk is this much, and the reward is this much. So it's a small risk to get a big return. So for me, it's worth it. Now I might have anywhere from $2,000 or $3,000 in the property, or I might have 10 grand in the property after closing costs, rehab, etc. But if I position myself in a good positioning where if the lender does call the note, then I could just refinance or sell the property or pay all cash for the property. So there's strategies there. With number two, for example, I had a guy named Carlos. I bought his property, and he was going through a divorce, and after like 6-7 years, him and his wife got together, and they were trying to buy a house, and they couldn't get a house, and they were calling me. They weren't being rude or anything like that, but it was kind of getting on my nerves because he was calling me like, "Hey, when are you going to refinance?" A couple of years later, he called me, "Hey, when are you going to refinance?" And I told him, "Hey, dude, I'm not going to refinance. We made an agreement to cash out the loan when the loan retires, so I'll help you go get a loan." So all I did is help him get a loan by finding a traditional lender and then providing that lender paperwork trails where that showed that this house is not Carlos's liability anymore, that is Mr. Investor, and I'm making all the payments. And I showed his lender proof of like 12 months of monthly paperwork that I'm actually paying that debt. So what happened end of the day is that he was able to qualify for a new loan because of the paperwork trail that I had. And so instead of that house that I got from him, even though it was under his Social Security, under his name, was his loan, the bank didn't include 100% liability on that property. What they probably did is just include 20% liability instead of 100% liability. So if his rent was, let's say, $1,000, his mortgage was $1,000 a month, instead of say, hey, Carlos is reliable the whole $1,000, they just say he's just reliable $200, and I'm paying the other $800. So that's one way the bank probably looked at it. But I think in this situation, they didn't even look at it like that. They just give him 100% liability free because they saw that I'm the one that owns it, the deed's under my name, I'm the making the payments. So simply put, when that seller came to me after second or third time, you know, I was able to help him get a loan, show proof, paper trail that I'm making money to his loan, therefore he could get out of my hair. But you know, a few years later, he still comes back to me and calls me and says, hey, when are you going to cash out this loan? You know, we don't want it to be on our credit, etc. So that's why I make this video, because, you know, everything's a risk. There's nothing risk-free. If you get in your car and you want to go to your mom's house, you can get in a car wreck. And that's riskier than due on sell clause, or that's more riskier than your seller getting mad at you. But I want to bring this up because I don't want everybody to think it's just glamorous to buy property subject to. You know, when I say you can buy properties with no money, no credit, that means that you don't have to use your money, you don't have to use your credit, but you still need money, and you can use somebody else's money, but it still requires money. So, in conclusion, I love subject twos, but I just want to bring 3 different ideas to you guys why subject twos can be risky. This is Mike with my Real Estate Dojo. Go out there and hustle and bustle. Don't take no for an answer. See you later, gang.